All right, welcome. Thanks for coming to the second talk at Manifest. Louis from Sovereign will be talking about prediction markets and finance. Sovereign is a very generous sponsor of Manifest, so you have him to thank for much of what you see here. And without further ado, I'll let him take it away.
All right. Hello, everyone. My name is Louis. I am the founder of Sovereign, the sponsor none of you have ever heard about before. So today I'll be presenting prediction markets applied to trading equities. I came up with kind of a full framework to essentially make money from trading equities by leveraging prediction market. Right. So in this talk, I'll start with in front of this. All right. So in this talk, In this talk, I'll start by going over a little background. So equity markets, especially with regards to prediction markets, we're gonna look at what do financial questions look in Manifold right now, a bit of qualitative and empirical look. Then we'll go into the proposed framework. So we're going to go over some forecasting best practices that I use kind of liberally to build the market, how to actually get those questions that we want to trade, how to get our good probability estimates, how to get money, and in the end, actually this is all an ad for my company. I'm looking for someone to do this. So if this is something that interests you at all, definitely just come talk to me. We'll have a booth at some point, I think. And yeah, let's get started. So just to start with a little background. So this talk, I'm just focusing on equity markets. It's mostly because it's easier and more accessible, but it's definitely applicable to most other markets. You could apply kind of approach to things like trading wheat, trading Forex. It's a very general approach. So kind of thinking about prediction market, what are equity markets? Well, they're a bit similar. They're essentially like prediction market, but they can really only ask one question. What should be the price of a certain stock right now with regards to essentially everything that is known? It's really hard to have kind of this separation of information with the stock markets, but they're very good at answering this one question. And now concretely, like the kind of cosmic reality doesn't really matter when you're pricing a stock, but there's a lot of things that do, and that you simply cannot ignore when you're trying to answer any questions about a stock. So the easiest one is, how is the company doing? But how is the economy doing? How might the economy do? What about known unknowns? How is the world doing? Interest rates? Is Wall Street Bets looking at your particular ticker right now? What is the base rate of your CEO posting a spicy X? There's a bunch of stuff that will impact essentially how you aggregate your information here. And stock markets are actually quite good at that. They're not efficient, but they're really hard to beat. They're generally quite good at this part, but what they're not great at is breaking down problems into sub-problems. If you have, let's say, a move of 1% in a stock price, answering the question of why that happened is really, really hard. There's no, we can make up stories, but kind of unless there's exceptional circumstances, post-stock rationalization doesn't get you there generally. You're quite limited in your ability to kind of figure out what is going on, what mattered, and how. Now, prediction markets, I don't think I have to sell them here, but they're a lot more general. I don't know what kind of option combo I would need to do that, but yeah. So for a quick recap for this section, basically equity markets are great at aggregating. They're not great at separating and breaking problems down. Prediction markets are great at that. So we really should be, at the very least, breaking down problems to the smallest unit that we think matters whenever we're using prediction markets to actually trade. Now, we're going to look at what's actually happening on Manifold. So those are the kind of the financial questions that are by volume on, I guess, whatever day I was doing the slides. It does seem like it's mostly around questions where we would expect we would expect us to not really have any type of edge. So it's questions very much of the form: what will stock price X do by date Y? And that is something that the equity markets already directly answer. I do not see why we would expect to have any edge in this kind of questions. Furthermore, since it's still the question still kind of implies the stock price, we still have this conditional on everything that is known at time t. We still have to aggregate all of that information. This is not kind of this is not in the Goldilocks zone of questions. So before moving forward, I wanted to actually check my assumption that those questions didn't work. And I kind of did just a really quick empirical study. Basically, I found 18 resolved question of the form, will the S&P 500 price go above or under X by date Y? Took the manifold probability halfway through to expiry. So there'd be like a decent amount of volume. Computed the market's probability at the same date with VIX and SPY. Basically, it's a quick... basically, VIX is essentially how expensive options are. And the more expensive options are, generally, the more the market thinks that things are going to move. So without going into details, that gives you a probability of a certain price move. And this is roughly what it looks like. So the red dot resolved to no. The green dot resolved to yes. I guess if you're colorblind, trust me. If you have a red dot above the line, the equity markets are doing better. And if you have a green dot underlined, the equity markets are also doing better. And what we're seeing from this is, at least at the extremes, the equity markets are much more confident. I mean, it's not a huge sample size, but it does give a certain idea of what's going on. And on the center, there's no real differentiation. I don't think we definitely cannot say from this that using prediction markets currently for those kind of questions would do better than the equity markets, who are, in a sense, answering the same questions. So for this part, essentially, prediction markets are great at breaking problems down, but current financial questions don't seem to do it enough. And equity markets are greater, or at least equal to prediction markets in predicting stock price. I think the ideal for prediction market in this kind of question is probably to match whatever the equity market is telling you is the probability of something at a certain point. Now, getting to basically our proposed framework. So to start, I just went through the 10 commandments of the Good Judgment Project. We find 2 that can be directly integrated in kind of building those questions. The other one are mostly about being a better forecaster, and that's the market's job as far as we're concerned. We're just trying to build problems that are useful for us to actually trade. So the first one is break seemingly intractable problems into tractable subproblem. And the second one is triage. We want to concentrate on question where we can actually be paid for our efforts. And so for breaking every question into components, we can essentially see 3 subcomponents for every question. Whatever is your question, there are 3 parts that you need to be able to accurately put the kind of position that you want. You need to know the probability of whatever it is you're looking at of happening, and you need to know what impact on something that you can actually trade it will have. So 2 expectations. If it happens, what will happen? And if it doesn't happen, what will happen? You do need those 2 things. Now, for actionable impact here, I'm really talking about what's the action that you're going to take that will, and how will it be impacted, that you will profit from. So the more obvious one is just a stock price move. I think AMD is going to do something, therefore its stock's going to go up. But now you're still at the same time predicting AMD and the whole market and the universe. What you want is to remove as much as possible. Something like a pair trade can really help with that. So you would maybe go long AMD, short another stock. Now you're no longer predicting kind of the whole market. You're just predicting the difference between two stocks, and that makes the problem much easier to actually predict while you're still able to directly trade it. You could also have something like a volatility impact. So if you think that a stock will be much more volatile, but you don't know which side you can go, that is something you can trade directly. So let's say that you know that Elon Musk gonna tweet something about Tesla, and it could be either very, very good, very, very bad, but you just know that it's gonna matter. It's gonna have a giant impact on the price, on the stock. This you can trade directly as well, or you can even volatility pair trade and kind of buy some volatility somewhere, sell somewhere else, and kind of remove more and more of the equation and predict exactly and trade exactly what you're predicting. So kind of as an example, let's say you have the general thesis to kind of bring it back to reality. Let's say you have the general thesis that AMD is gonna kind of get its shit together and give us a better something that's equivalent to CUDA, and it's gonna start getting some market share in the GPU market. So you'd have the general thesis AMD will make strides in the deep learning GPU market in coming years. So maybe your question will be something like AMD will gain 5% market share in the deep learning GPU market in 2024, of which you can find a few actionable things. The easy one would be stock price goes up in 2024 if it's true. You could also say it's going to beat the market, but probably the best way to trade this is to actually short NVIDIA while you're buying AMD. It's stealing market share from NVIDIA. If the deep learning boom busts, you could actually lose money with the second option, since the market's going to probably outperform those things. So you want to formulate it in a way that whenever you're right, you will not lose money. You will actually win. You want to have as close a position to what you're actually asking in the market. And for the second one, it's triage. So you want to find actionable questions about a company, so that we just went through, but you also don't want to go through something that's so obviously the only thing that matters. So in this case, this is the Red Hat historical price after an acquisition was announced for several months. This is no longer an equity market. It is a prediction market on if the stock will actually go through. So you no longer have the advantage. You're no longer using your edge of being able to be modular if it is clearly the only thing that actually matters. You know what? I'll just... Oh, sorry. Oh, okay. Yeah, I'll put it here and keep it here. All right. So in a sense, we're looking for breaking our problem down. We're looking for the probability of something happening, the expectation of whatever action you've chosen, knowing X and knowing not X. You want to know the positions you've had, kind of how they'll impact you either way. And you want to frame that action in a way that is most dependent on X, essentially in whatever decision you've made. And as far as a triage, you're looking for impactful question, but not all-encompassing question. And now we'll actually go into the details of like how you can actually find those actionable questions in the equity markets. So there's kind of a lot of hypothesis mill freely available in equity markets, just places where kind of everyone has opinion. There's a lot of opinions out there, and there's a lot of noise to be filtered through. It's a bit of kind of a clam approach where you're just kind of filtering the stream until you find something that's worth it. So that's more or less the approach. Generally, you'd have something. So as a first example, you'd have something like earning calls. So Cineplex is a Canadian cinema microcap. They focus on something called VIP cinema. So it's cinema with like a very comfy love seat, heated reclining seats. There's a bar, there's restaurants, and that kind of experience. and it's currently trading at a premium because this is a growing category. The general thesis is that, and they mention it in their earning calls. So that's the nice thing about earning calls. It's once a quarter, companies just tell you what to look at. And so for something like that, you'd be essentially, the way you'd essentially come up with a question is you see what the company says, you start thinking about it a bit. Maybe you'd look at the Google Trends for whatever they're looking at. So you can see that VIP cinema is back at pre-pandemic highs. Maybe it's going to keep going. Think about it a bit. The general thesis is that with streaming and straight to the streaming video, probably cinema has to be a better experience than it used to be. You do a little market research. I went to see Barbie with the boys at one, and it was a great experience. It's a movie that really gains from being a little tipsy. So in this case, these are the kind of question that you'd come up with. What is the probability that Cineplex revenue share from VIP cinema grows by 10% year on year in Q4? How much will Cineplex outperform AMC if it does? How much will Cineplex underperform AMC if it doesn't? So from here, you can kind of build the kind of questions that if you had accurate probability of, you could profit. And it is questions that are likely to be impactful. You can also go through 10K and 10Q filings, which are kind of the same general idea. The companies just tell you what matters. And that's a pretty good way to go about it. But generally, one of the issues with those approaches is that everyone else knows about them. So there's another approach with this, which is essentially to trudge through the internet. So Seeking Alpha, Twitter, Discord, Reddit, there's kind of a lot of theories out there, a lot of other theories. Filtering in this case is really much the name of the game. Most of it won't be meaningful, won't be predictable or even sensible, but there's some really good stuff out there. And generally it won't be like 7 steps of logic. It will just be very obviously correct stuff that's just happened for the first time. So someone will essentially put 2 and 2 together at first. You'll be reading it. It generally takes an earning cycles for it to be well understood by big firms. And this is something where questions are fairly interesting. As an example from a Discord called Dumb Money back in the 2020 stock craze, one of the trades they were looking at was the impact of the November freeze in Texas on pool repair company stocks. So they had a bunch of burst pipes in Texas because there was a big freeze which never happened. And during the essentially dead season of those companies, they had booming business and a huge windfall. These kinds of theses are very simple. They make a lot of sense. Sometimes you fall on something that is that good if you just kind of look through the internet. And they're probably where at the end of the day you'll make your most money, because those are kind of the 90%. Those are the high conviction trades at the end of the day. Other than that, that's one that I actually took from Bern Hobart's newsletter. So 13F filings. There's a bunch of hedge funds out there that make their position public once a quarter, and some will be unknown, basically long unknown microcaps. And it can be fairly clear why once you actually look into them. So these stocks should generally be pretty ripe for reverse engineering questions. So for this section, there's nothing really prediction market specific. It's just a way to kind of filter through stories, to come up with ideas, and to kind of find the questions that you can actually make money out of. All right. Now, once you have a bunch of questions, how do you get good probability estimates? Well, I think we have a pretty straightforward way with leveraging Manifold. And after that, I think building in-house expertise will also be important. So first, you need a lot of mana. And it starts with mana. Then questions of the form, what is the probability that Cineplex revenue share from VIP cinema grows by 10% year on year in Q4, are boring. and are not intuitively easy to answer. You need to subsidize them a lot if you want to have any kind of traction and any kind of interesting prediction. They're not impossible to guess questions. They are just not obviously common knowledge questions. So they do require an effort. And to get any type of traction, you're going to have to actually work and, well, basically work with Manifold and get a lot of mana. But through those kind of approach, you can kind of get a first step. I don't think this scales infinitely because at the end of the day, you're telegraphing to the world what you're planning on doing. But I believe this kind of approach, unless you're touching microcaps, can scale deceptively far. There's just not that much big hedge funds that are going to compete with you and then basically take those probabilities from Manifold unless they're very involved. And then you'd probably want to build some in-house expertise. So after those subsidized markets, you can have a pool of people participating that you have a lot of data on. You probably just offer them more than mana at some point. You offer them a slice of the P&L. You offer them something, and you start building your internal tournaments, especially for those questions where you think that having external eyes would remove the edge. So when you're trading microcap, when you're trying to take a large position in something that doesn't have that much space, or when you're trading something that you feel very strongly about and you would like to take a very large position, these things are generally better run internally, and this kind of gives you a direction to actually get those. All right, now how to actually get money. So at this point, you've got a list of actionable questions and you have estimates of probability of those events and the impact of those events. Something like the Kelly criterion is pretty ideal for this. So in a sense, the Kelly criterion is the mathematical formula that provides an ideal size of a trade using the probability of a win, the probability of a loss, the size of a win, and the size of a loss, which we have estimates for all of those. So depending on the quality of your estimates, you probably should trade it like that if you're making single trades. There's also approaches that would be more of a portfolio optimization approach. At this point, I was losing a little steam in the presentation, but yeah, okay. Kelly criterion. Okay, so we'll get to the ad break. Quick slide. I wanted to get my money in for the logo. I like my logo. All right. Okay. All right. So who am I? So I'm the founder of Sovereign. It's a it's a trading fund based in Montreal. Anyone has water? Okay. It's a trading fund based in Montreal. Our background's very much in deep learning and machine learning. So we've got Kaggle masters, we've got a lot of kind of the Mila crowd, and we're kind of looking to expand into different strategies. The reason that I'm here is that I noticed that Jane Street was here, that Citadel was here, and that I don't necessarily understand why not. This is a place where people, for fun, not even for money, predict markets and look into forecasting. I feel like there's probably a really good pool of talent here, and it kind of sounds like if I come with a good enough offer, I might get dibs. So that's the main motivation here. Now, thank you. Just give me a second. All right. So basically, what's the main offer? What's the main value proposition that I have for you guys? Really, it turns a lot around the way I do IP. I'm looking at 80-20 partnerships where you're the senior partner. You get 80% of whatever you end up developing. You would have right to this. Basically, the idea is either you stay in-house or you start your own company in which I can buy 20%. Other than kind of the ownership over whatever you develop, you'd also, get all the normal good stuff of employment, money every 2 weeks and that stuff. So that's kind of the that's the main differentiator. Other than that, everyone else at Sovereign has the same deal, and that leads to a lot of orthogonal thinking. There's really good lab discussion. It's a lot of strong personalities that are pushing in their own directions that don't really. It's a lot of people who don't like being told what to do at the end of the day, and that makes for good, interesting, spirited discussion. While also, since everyone gets to do what they want to do, it still works in the end. I think it's good for collaborative talk. I don't think we could actually all collaborate in the same project, but for kind of what I'm going for, it's really nice. So I'll come back to this right after. So if kind of having your own, if being in charge of your own thing from day one is something that appeals to you, just talk to me during the conference or during, I don't know when the booth is, because I'm definitely interested. Or if your background's more in machine learning, deep learning, we're also always looking for more of that. Generally, what we're looking for is people who kind of have done something on their own. It's as much as possible, I'd like someone who kind of has one thing to point to that I can be confident that they'll be able to kind of being thrown to them, being kind of without direction, that they'll slowly get to somewhere that's worth it. So it doesn't have to be top 10 manifold, but you would have to be a good forecaster. You would have to understand the field, because else it's going to be very hard to actually build those things from scratch. So yeah, we'll have a booth. The QR code is for the job posting. So if you want to just stay in contact or fill for the job posting, feel free. And if you have any questions, that is it for me. Yes.
How do you think about what cases you would have an information advantage in, and how to, basically, so take the simplest one. So there's probably a data set of Canadian credit card spending. There's definitely a data set of email receipts that includes Canadian data. You could also run a web scraper that just looks at the number of tickets left in VIP rooms. So like that doesn't mean it doesn't work, but it means that there's potentially more competition. Like the price may actually reflect what you are looking for already. So how do you, aside from what we discussed earlier of just mergers that people shouldn't talk about but do bet on, what are the categories where you think there would be potentially an edge against?
So I'm kind of going with the assumption that prediction markets kind of as a tool both lead to better predictions and kind of are probably a better way to remove bad predictors. So if we're talking about the using manifold, I think at the end of the day, you're just gathering more kind of opinions. If one of those places basically just had an internal manifold competition, well, that's kind of the end game of what I'm proposing. So then we would not have an edge here. The idea is just to kind of leverage what is known from prediction markets that, they do better than experts quite often on many fields, figuring out where they can do better than experts on equities, and just keep doing that until it doesn't work anymore, I guess. Yes.
When you set up a prediction market, sometimes you get a really good estimate of like 1,000 traders and it's creating an exact percent, and sometimes you get like 3 traders and it's you don't really know what the real probability is. How do you adjust for that?
I feel like you just subsidize more. Like in a sense, that's kind of that's probably a problem. Like since there's also I guess a limited attention pool for people to buy, so it might be a bit of a race to the bottom if this kind of approach actually takes off, where you do end up having to spend a lot of mana to have any type of interest. I think right now it's pretty early, and probably as long as you don't flood the market with a bunch of questions, you might be able to get a good spread. But I think as thing goes more, you're gonna have to just either have people in house or just buy more mana. Yes. Yes.
So I'm wondering about the 3 things you need to know: the probability, the impact if it does happen, impact if it doesn't. I'm curious about which one's accuracy is more important for, or does it depend example,
Mhm.
Clouatre would say for a black swan, you don't need to know the probability that well because everyone misestimates the impact.
Mhm.
So I'm curious, like, when do you actually need to know, and which ones can you maybe just fudge?
So I guess it depends. But also that is something you could kind of have a running tally for all of those yourself. So essentially, you'd want an estimate of your estimates, and probably you're never trading full Kelly here because you don't know the actual probability. You just know of some guesses, and you know how well other guesses have been, how good the other guesses have been. So it's probably, I don't know actually, because you can think of a scenario where you're thinking of, let's say, the probability of something that's probably not going to happen, a 1 in 10, that's going to be 10x up and nothing down, then I'd say probably the 10x up or the probability of it happening are the two important. And unless you're really, really wrong about the, well, it depends how wrong you are, I guess. Yeah, because I'll think of it on my some other time. Yes. As much as possible, I try to, I guess, not look at what other people do. There's a lot of things that don't work for, but actually do like the second time around. Sometimes it's just about the implementation. Sometimes it's about the people. Sometimes you try the exact same thing and it works. It could be because of what year it's been done. I'm always a little. I guess when I design something like that, I'm always a little wary of getting too influenced by other people's results and thoughts. Well, thank you, everyone. It was great.